Maya graduated top of her class in finance and could explain options, pricing models in her sleep. She also lost $11,000 in 2021 trying to predict the exact bottom of a market crash. Warren Buffett, a man who admits he reads balance sheets slower than his own assistant, earned millions that same year doing nothing. This isn't a story about intelligence. It's a story about temperament. And that difference costs people fortunes every single year. Today, we're breaking down the exact mistakes that quietly drain smart, capable people's bank accounts year after year. Stick around, because Maya makes one decision near the end that changes everything for her financial future. There's also a very good chance you've made the opposite choice she made, sometime within this past month. Brilliant people lose money for predictable reasons, and none of those reasons are a lack of raw intelligence. Before the list starts, here's the one idea worth holding on to. Every mistake below wears a slightly different costume. It's the price of trying to outsmart the market instead of simply learning to outlast it with patience. Mistake number 1 is trying to guess the market's next move, something Maya was sure she could do. In March 2020, she pulled her entire retirement account into cash, certain the crash had much further to fall. The market bottomed 11 days later and rallied 30% before she found the courage to buy back in. Buffett has said plainly that he has no idea where stocks will be in a month, and neither does anyone else. The market makes most of its long-term gains on a tiny number of days scattered unpredictably across decades. Miss the 10 best trading days in 20 years and your total returns can get cut by more than half. The painful twist is that many of the best days arrive within weeks of the scariest, worst days. Selling in fear doesn't protect you from the storm. It just guarantees you're absent for the sunrise after it. The lesson isn't that crashes can't hurt you. It's that guessing the exact bottom almost never actually works. Time in the market beats timing it, mostly because nobody, not even professionals, can consistently call the turn. Mistake number 2 is paying fees that never show up clearly on any statement you actually read. A 2% annual fee sounds small until you watch what it quietly does over 30 years of compounding. $100,000 growing at 7% a year becomes $760,000 with no fees involved. Pay 2% a year to a fund manager instead, and that same money finishes near $430,000. That gap, over $300,000, is the cost of paying someone to babysit money that didn't need babysitting. Buffett once bet a hedge fund manager that a plain index fund would beat hand-picked elite funds over a decade. The index fund won by a landslide, and the winnings were donated to charity as a final exclamation point. Think of a yearly fee as a quiet passenger riding along for free, taking a growing cut every single year. Mistake number 3 is letting fear and excitement make every decision, instead of following any actual written plan. Studies on investor behavior consistently show the average trader earns noticeably less than the market itself actually returns. The gap exists because people sell in panic and buy back in excitement, almost always at exactly the wrong moments. Maya checked her portfolio at red lights, during dinner, even in meetings, treating every small dip like an emergency. 40 trades in a single quarter left her with worse returns and a tax bill her patient friends never paid. Activity feels productive, but rarely is. It's often just the price of feeling in control of something uncontrollable. Every sale also risks a tax bill, while the patient investor next door keeps compounding completely, untouched and undisturbed. Mistake number 4 is buying things you genuinely cannot explain clearly to another reasonably intelligent person over coffee. Liking a product is not the same as understanding the business behind it, no matter how good that product is. Buffett calls this the circle of competence, and his rule is simple: know exactly where your own circle ends. He avoided technology stocks for decades, which meant missing Google and Amazon, 2 of the greatest businesses ever built. He's called that decision a mistake, though he's also said missing a gain stings far less than losing money you actually had. Maya put a chunk of her savings into a company because the ticker was trending and a friend called it huge. She couldn't explain how it made money, who its real competitors were, or why it deserved that price at all. That isn't investing. that's a guess wearing a nice suit. And guesses eventually get caught without their clothes on. Every booming sector attracts the same story. A rising price gets mistaken for proof, right up until it isn't. Mistake number 5 is falling in love with the exact price you originally paid for something you own. Maya bought a stock at $60, watched it drop to $40, and bought more, calling it a bargain. It dropped again to $20, and she bought more still, convinced the lower number made it an even better deal. The stock eventually fell toward zero, and Maya hadn't found 4 separate bargains. She'd bought the same mistake 4 times. The market has never once heard of the price you paid, and it assigns that number exactly 0 importance going forward. Buffett's advice for this exact trap is almost insultingly simple. If you find yourself in a hole, stop digging. The only honest question is whether you'd buy it again today, knowing everything you currently know right now. Mistake number 6 is following aloud. Confident crowd straight through the door mark danger up ahead. Buffett borrowed a line from his mentor. That being right has nothing to do with how many people agree with you. His famous warning compares speculative bubbles to a ball where everyone privately plans to leave 1 minute before midnight. The problem, he wrote, is that inside these particular bubbles, the clock hanging on the wall has no hands. Meme stock investors in 2021 learned this lesson live, watching shares triple in weeks, then quietly erase those gains. A loud, confident crowd isn't proof of anything, except that a lot of people are feeling the same emotion together. A crowd can hand you a great entry point, but it will never once tell you the right time to leave. Mistake number 7 is borrowing money to make your bets bigger than your actual available savings could support. To Nobel Prize-winning economists once ran a hedge fund using borrowed money at roughly 25 times their capital. A small 4% move against their positions wiped out the entire fund and required a multi-billion-dollar rescue. Buffett's eulogy for that disaster was blunt. Smart people risked money they badly needed to chase money they didn't. Leverage doesn't just raise how much you stand to win. It quietly removes your ability to simply wait out a downturn. A normal investor sleeps soundly through a 25% dip, while a leveraged investor gets forced out at the bottom. Borrowed money turns a temporary, survivable dip into a permanent, irreversible loss simply by removing your ability to wait. Mistake number 8 is confusing the price flashing on your screen with what something is actually worth underneath. Buffett's entire philosophy folds into 7 plain words. Price is what you pay. Value is what you get. A stock is a small slice of a real, living business, not just a number bouncing around inside an app. When the price drops, but the underlying business genuinely hasn't changed, Buffett doesn't see a loss, he sees a sale. Buying something purely because you believe someone else will pay more for it later isn't investing. It's pure speculation. Maya knew the price of everything she owned down to the penny, and the actual value of almost none of it. She'd spent years staring at the price tag and had simply never once asked what was actually inside the box. Mistake number 9 is selling great investments early, simply because the current gain already feels good enough. Buffett's ideal holding period, by his own description, is forever, as long as the underlying business stays genuinely strong. Compounding looks nearly flat for years before it suddenly accelerates, and most people quit during that flat, boring stretch. $10,000 growing at 10% a year takes roughly 30 years to reach about $174,000. Leave that same money alone for 10 more years, and it grows past $450,000 total. More than half of that entire growth happens in the final decade, the one most people never stick around for. Buffett earned the overwhelming majority of his fortune after turning 60. Not because he got smarter, simply because he waited. He didn't get rich quickly. He got rich slowly for decades, and then suddenly, all at once, near the very end. Mistake number 10 is misunderstanding what real diversification actually means for someone in your specific situation. Buffett has said diversification mainly protects people from their own ignorance and barely matters if you truly understand a business. He also instructed that after his death, his own wife's inheritance go almost entirely into one simple, low-cost index fund. Both statements are true at once, because the right answer depends entirely on how much real homework you've genuinely done. If you can't clearly explain what you own and why you own it, one broad fund isn't settling, it's wisdom. The mismatch isn't between concentration and diversification. It's between your strategy and how much real homework you've actually done. Mistake number 11, the quiet one, is keeping money safe in cash for decades and calling it caution. Cash doesn't crash dramatically, but it does something slower and arguably worse. It silently loses buying power every single year. Buffett called inflation a tax nobody votes for. When that appears on no bill yet costs you constantly anyway. $100,000, sitting untouched in cash for 20 years, can lose nearly half its real purchasing power. Emergency savings absolutely belong in cash, sitting ready. But long-term wealth left rotting in cash is a slow leak. Short-term money in cash is wisdom. Long-term money in cash is simply a quiet, invisible loss every year. So that's the full list: timing the market, hidden fees, emotional trading, and buying things you don't truly understand. Also anchoring on the price you paid, following loud crowds, using leverage, and confusing price with actual underlying value. And finally, selling winners too early, misjudging diversification, and quietly hoarding cash while calling it responsible, careful behavior. None of these mistakes are really about intelligence. Nobel Prize winners have made several of them and lost billions doing it. The smartest person in any room can still make every single one of these. 12 mistakes in one lifetime. Maya, somewhere around mistake number 9, stopped selling her winners and let one genuinely good investment simply keep growing. She moved the company she couldn't explain into a plain index fund and finally slept through an ordinary red day. She didn't get a higher IQ overnight. She just stopped fighting her own worst instincts on an unremarkable Tuesday afternoon. Buffett's longtime partner Charlie Munger put the whole philosophy in one line: I'm to be consistently not stupid, not brilliant. That's the entire secret hiding underneath decades of letters, quiet patience, and a stack of boring, wonderful businesses. None of this requires a higher IQ. It just requires you to stop being your own worst enemy on an ordinary day. This isn't financial advice, just patterns worth noticing in your own behavior. And what you do with them is up to you.